Welcome, everyone. Thank you for joining us today. You're definitely in for a treat. Today's presentation is, are your books in order to get funded this year? We're not sure that this webinar could be more timely considering everything that is happening of late in the banking industry and how it is and will continue to affect small businesses. For those of you new to us, Founders First CDC is the largest national platform for growing businesses led by diverse founders. We offer strategic expansion programs, coaching, grants, and resources like today's webinar to help you grow to 10 million and beyond. We are a 501c3 nonprofit, which means we will happily accept donations, and we have been around since 2015. So we only have 30 minutes for today's webinar. Let's get into it. A couple of housekeeping items. The webinar is being recorded, so no worries if for some reason you need to hop off early. Our presenters will be answering questions at the end of the session, so you can submit those using the Q&A feature, and we also have some questions that were sent in through the registration form that we will be answering. And finally, if you lose your connection today, you can just log right back on using the link provided. And now I'd like to introduce today's speakers. We have Danica Coit. Danica is the CEO of Terra Business Solutions, the premier remote CPA firm in the United States. Terra Business Solutions is headquartered in California and offers the full spectrum of services from bookkeeping and tax preparation to assurance and tax planning. Danica has over 25 years of experience in accounting, taxation, and assurance. She has brought her holistic approach to all of her businesses, which include proactive communication and taking the time to really learn and understand clients, their business needs, and goals. And since 2018, Danica has served as one of our financial coaches to our members. We are also joined by Ashley Oguadimma. Ashley is president and COO of Quality Interactions, the leading provider of cultural competency and implicit bias training for the healthcare industry. Quality Interactions offers custom online solutions to meet the growing demand for quality DEI solutions. In her role, Ashley is focused on ensuring QI's growth and profitability through the expansion of core products, strategic partnerships, and exploration of new markets. Ashley has over a decade of experience in organizational leadership, curriculum development, and operations management. And we are proud to say Ashley is also a Founders First Fast Path program graduate. We're happy to have both Danica as well as Ashley as our speakers today. So Danica, you can take it away.
Well, thank you so much for that introduction. I also want to make sure that I introduce one of our financial coaches and fractional CFOs, Jules Ellis. Jules is a licensed CPA who has been working over 20 years with small businesses and medium-sized businesses to help them grow and scale. She really has experience in multiple industries, and she could really add a lot of value to help you understand your financials, what you're looking at, and how you can get funded in 2023. So let's just go through some of the agenda items. I just want to touch base on some of these items, keeping in mind that we really are going to focus on kind of the financial statements, and we will make sure that we leave some time at the end for, questions and things of that nature. So first of all, financial statements, they're first on the list. They are the lifeline of your business, and you will see that everything else on this list relates back to the financial statements. And it's really about making sure that your financial statements are accurate and up to date. So let's just briefly go down the list. Past due invoices. If you can just go back one, I apologize. So past due invoices is really about making sure that all of your invoices are collected. And if, for example, one of the lenders, they a lot of times ask for an AR aging report or something of that nature. If you have any clients that are 30 past days, 60 days past due, or anything of that nature, this will give you time to really explain your collection policy and how you are really, making sure that those get collected and you're on top of things. The next thing we have on the list, and I'll kind of go through this briefly, collect forms. This is just about your vendor policy, your payroll policy, your onboarding policy. Are you retaining documents? How you're retaining documents? I'll give you an example. For example, if you have a vendor management policy, you collect the W-9s right away. So at the end of the year, you're not scrambling to meet the 1099 deadline. As far as payroll goes, making sure that you have all your employees up to date per their state. Also on the payroll side, it's very important that you're accruing for any liabilities. So for example, if your payroll happens on the last day of the month, but it doesn't hit your cash till the next month, you want to make sure that those payroll expenses are in the correct month when they actually happened. Next, we have your account for inventory and organized business receipt. The inventory is just to make sure that the inventory balance that you have on your balance sheet is accurate, that you're doing at least annual counts, if not quarterly or monthly, and that you're making sure that your assets are accurately depicted. And the business receipts is just kind of like making sure, okay, do you have somewhere that you're organizing your receipts? Are you keeping them, do you have good record keeping? Are you using account software? Or are you managing your books just by a shoebox, like we like to say, joke about? And last but not least is reconcile bank accounts. And we say bank accounts, but we really mean reconcile the full balance sheet. Bank accounts should be reconciled at least monthly, but the full balance sheet should be reconciled at least annually. This will ensure that when you turn your financial statements into a lender, they are accurate, they don't have questions or concerns just based on looking at your balance sheet. I will say that most businesses review their income statement only. And that's something we'll talk about today. The balance sheet is extremely important for the business. So we can move on to the next slide now. These are your financial statements, and that's what we're going to focus on today. This is what you're really going to have to provide to a lender, an investor, and I think we say at least 3 years they're going to want to look at. So it's very important to have these up to date at least annually. But if you don't have a cash issue, I would say monthly would be best practice. That will allow you to kind of review them on a regular basis, make decisions with your leadership team and things of that nature. So as we get into the financial statements, I am going to pass it over to Jules. Jules has a lot of experience really working with businesses to make sure that these are in order so they can get the best funding options. So Jules, go ahead and talk about the income statements.
Got it. Thanks, Danica. Most businesses, as Danica said, only review their income statements, and there are several reasons for this. The first one, quite frankly, is that it's much easier to understand than a balance sheet for someone who is a non-accountant, who is most of the world, quite frankly. But as Danica said, your balance sheet is also very critical. So if we could look at the main parts of your income statement, so in case you're not familiar with it, hopefully this will help you. So your top line is always going to be your revenue. And that is the money you're bringing into the business. And, one of the things that I always recommend to clients is if you have different streams of revenue, please make sure you break those out. Number one, it helps you understand how your business makes money and how it also spends money to make that revenue. And it also shows a lender that you have multiple streams of revenue, which is always attractive. Another thing that's attractive to lenders is if you have recurring revenue, something like what they call a SaaS model, which is software as a service, or anything else as a service. That is a recurring revenue model and will always get a lender's attention because there is a potential for recurring revenue far into the future. So moving on from there, we look at operating expenses. These are typically denoted as the expenses that are the direct costs that you expend to make your revenue. So you're talking about the payroll for your employees who either make your product or perform the service that you derive your revenue from. Supplies expense, could be software expense, depending on what your industry is. So these are specific direct costs. Moving on from there, what you get is what they will call, and it's not on this particular slide, but it's called gross margin or gross profit. It shows you, it's listed here as operating income. It shows you it's basically your total revenue minus your total direct costs for your revenue. And you get gross profit or gross margin. That's also often expressed as a percentage. These numbers are very critical in helping you run your business. It shows you, off the top line, what does it cost you to make your revenue? What are the, like I said, direct costs? Everything underneath that are things that cost you money, whether you derive any revenue or not. So if we move it on from there, what we have listed is non-operating revenue, expenses, gains, and losses. So in the accounting world, these are what we call G&A expenses, general administrative. So these are things that will be a constant expense, even if you have no revenue that month. Think of it as office rent or warehouse rent, depending on what kind of business you have. Insurance, perhaps subscriptions to things that you need, office supplies that you have ordered. So those are what we call indirect costs. And eventually that rolls down into what we call net income. And a lot of companies, that's where your income statement will stop. If you have anything like interest income or interest expense, those will roll at the bottom of that and be deducted from your net income. And not every company has that. So that's something, if you don't have it, don't worry about it. It probably means you don't have debt, which is not a bad thing. But these are something that, if we meet with you, we would look at your specific income statement and be able to tell, here's where your cash is going. Here's where perhaps you could save money or renegotiate contracts, and be able to help your business be as successful as possible. I was writing a couple of notes as I was thinking while we were preparing for this. A couple things I would recommend that have a big bearing on your income statement is most accounting software, if you're using accounting software, has the ability to attach an invoice onto an expense that is loaded into your, typically QuickBooks is what people use. I saw a question come through a second ago. Somebody's gonna have to read me the rest of it because it went off my screen. But there are places to attach the related invoice to every expense. I highly recommend using that function. If you ever get audited or ever need the copies of those, they're all right there for you electronically, and you don't have to dig in a closet somewhere. Hopefully that it's in a file. The other thing, we talked about having separate streams of revenue. I would highly recommend that as well. If you only have one type of revenue, there's nothing wrong with that. But if you have a way to show that you have multiple streams of revenue, that just strengthens your position with a lender. We talked about payroll processing. Danica mentioned that earlier. One thing I always recommend, especially to smaller businesses, is unless you're an accountant, I never recommend doing your own payroll. Getting sideways with the IRS with payroll taxes doesn't take very long, and it's very expensive to fix because you have to hire somebody to help you fix it, and there are fines and penalties involved in that. And that's just one that I tell people, just don't do it. Stay far away from that one. And also, again, with your income statement, if you have a business that involves a lot of business mileage, let's say the one I can remember distinctly in my background, I had a painter and he had 3 crews. And so they had extensive auto expense. What I always recommend to people, if you have any amount of mileage and auto expense, make sure you keep a detailed mileage log. If you're ever audited, that will be the proof that you used that vehicle for all of those expenses. And I have actually been very successful in defending one of my clients to the IRS, who they were going to throw out about $30,000 in auto expense. But because his wife was a former accountant, she kept excellent mileage logs. And if you're just using your car to pick up supplies and you don't have extensive mileage expense, I would still recommend keeping one at least monthly, so you have some kind of backup for that, because that's one of the first things that the IRS likes to go after in small businesses if they have an audit. So moving on to the next slide. Janine, can you move to the next slide, please? Thank you. So moving on to the balance sheet. I will tell you the balance sheet is something that few people will understand from a technical standpoint. I always like to sit down and try to come up with a simple example for business owners, CEOs, et cetera, so that they can understand it from a high level. I will tell you, Danica and I have gone to school for a lot of years to understand this in total. but it is I'm able to make a simple example so that somebody else can understand it without being an accountant. What I will tell you is that this is the first thing that a lender is going to look at, because they want to see, what are your consistent bank balances? What are your consistent credit card balances? Are they reconciled? That if you have a company that has inventory, they want to look, do you have consistent inventory, or does it have, large seasonal highs and lows? Like if you sell things to retailers at Christmas. So there are a lot of things that make the balance sheet important. And there are a lot of things that will stick out to a lender on the balance sheet. So if we're looking at the top, we start looking to, they consider current assets to be, cash, accounts receivable, inventory. So one of the big things on a balance sheet is your accounts receivable. If you have a company where you bill people to be able to collect your revenue, they want to be able to see that you have consistent billing practices, that you have signed contracts with your clients, and that your clients are actually paying. So they will want to also see what they call an accounts receivable aging summary. So they would want to look how many of your clients owe you money from 30 days that's only 30 days old, and 60 days old, and over 90 days old. That will tell them, is your business able to collect from their clients, and how quickly are they able to collect from your clients? So moving down from there, in the middle of the page on the left, it says property, plant, and equipment. This is where all of your what they call fixed assets are listed. If you have equipment, if you have vehicles, if you have computer equipment, laptops, servers, et cetera, that's where all this will go. And the value of that gets reduced over a function called depreciation. If anyone's a detailed explanation of that, I'll be happy to explain that at another time. But basically, the value of this is reduced over time based on IRS regulations. Moving down from there, we have sections called goodwill and tangible assets. Basically, you only have goodwill if you've bought your business from another person, or you've bought a customer list or something like that. So that's not a typical thing you would see on a brand new business. On the top right, where we're talking about liabilities, so short-term liabilities are things like credit card balances, accounts payable balances. And here's another thing that a lender is going to focus on is your accounts payable. How consistent are those? Again, are there seasonal differences, et cetera? And, again, if you have a business that sells to retail at Christmas, you're going to have large spikes in inventory, probably the last half of the year, et cetera. So they like to see, is your cash flow consistent, or does it have, explainable differences? And also, how far behind are you on any bills, or are you keeping them very current? So that's very important to a lender. So below that, we have long-term liabilities. Those are things like bank loans, lines of credit, any kind of investor funding that's not based on equity, that's, based on a repayable loan. And again, there are places in QuickBooks where you can attach the documents if you have these loans. We highly recommend that you attach that so you have those, at hand at all times in case they're needed. Last section is stockholders' equity. This is probably the hardest thing for non-accountants to understand, so I'll try to make it easy. Basically, this shows the investment in your business that you or any of your investors have made. It also shows what they call retained earnings. Retained earnings is simply the aggregate of your net loss or net income over the entire life of your business. So in your first year of business, it's only the first year's net income. After year two, it's the total of those two. So moving on from there. So cash flow statements. This is a kind of a more formal cash flow statement format. What I always recommend for smaller businesses is in the very beginning, what I call kind of a cash burn format. Basically, you start out with what is your cash balance at the beginning of the month? What did you or what do you expect to spend in terms of inventory, loan payments, payroll, supplies needed for the business? And then you can project what your bank balance, your cash balance would be at the end of the month. This one, I think, is probably one of the most important things for a small business, especially in the beginning, when you're burning cash instead of, making more cash than you're spending. This is one I like to sit down and do with small businesses. You can customize this out. You can do this by week, you can do this by month, and you can project it out as far as is, reasonably predictable. And I think this is probably one of the easiest statements to understand for a new business owner, and one of the more critical, because it shows where your cash is going to ebb and flow. And it's also going to show you very quickly where you may have a cash shortfall, where you may need to find, an investor, a line of credit, a bank loan, et cetera.
So I think now we're going to pass it over to Ashley, so she could kind of speak to her experience with Founders First, as well as with getting a loan and things that she, could add value here. Thank you.
Thanks, Danica and Jules. Really great insight. I know we only have a few minutes, so I'll try to keep it brief. I won't go too deep into our funding journey, but one of the things I will share as a woman of color and in an active fundraise, we're in a capital raise right now, so trying to get to 1 to 1.5 million. And it's been a long journey to get there, right? And so that may not be the case for some of you right now. And some of the things that I want to highlight is, our initial investment, if you will, was actually a loan from a bank back in 2016. That was kind of how we started and on the journey of getting some of these documents together that Jules is talking about. And in 2017 is actually when we received our first investment. And one of the things I've realized over time from now until then, as we continue to kind of get these tranches of investment from investors, is as a business owner, you're spending a lot of energy into proving your company is viable and that you can pay it back. If you give me this money to grow, I can, you give me this funding, I can return that investment. But I also want to stress the importance it is to take time to really assess the quality of who your lenders are as well. And so making sure your books are in order, but also assessing the people who are assessing you, if you will. There may be a time when you have to agree to terms or things that don't feel as favorable early on because you're in really, you're in dire need of that money to really grow and you need the capital to get you there. So I would highlight that it's more important that you have a favorable relationship with who that lender is and that you're feeling really solid about that investment, knowing that it may come with terms that don't feel as great. And so making those kind of mental trade-offs throughout has definitely been a piece of our funding journey. As well as understanding that funding is the lifeblood of a company. And so there's how will this money advance our business? You're not necessarily, and some of you may be looking for startup funds, which differs from growth funds, right? And so understanding the nuances behind the different levels of capital and how you're having a game plan for how you're going to go after that capital in order to see the return on the investments are all equally as important as having your financials together. One of the things that we have at Quality Interactions is I thought it was really important for us to just have a CFO. So when we were able to, start making money and growing, I said, that's exactly what we need. And so leveraging the expertise, if you're not in the financial situation to hire out, definitely using the tools. I would imagine Terra Business is offering some supports in that way. And there are others where you can really get some expert opinions and weighing and to teach you as well as you go along. So it's not just handing all your financials over and blindly saying okay, I trust you, but you want to be able to do. You also want to be able to learn as you're going what we're looking at. What is a cap table? What are the balance statements saying? What are the cash flow statement? How do I plan out a projection and go from there? I would say some of the speed bumps I mentioned earlier, as a woman of color in this game, it's not been an easy ride, right? I feel like there have been opportunities and times in which I'm really having to prove that maybe the standard has been to provide 3-month statements, for example. 3 years of tax statements, and I might be asking for all of the tax statements, right? And so there's no way of knowing, what's fair in the minds of funding, but being prepared, I think, has been the biggest piece of advice I could offer. There are going to undoubtedly be turbulence and speed bumps along the way. But I think there's this saying that if you stay ready, you don't have to get ready. And so if you are constantly planning as you go along, not mentally waiting until it's tax season to get all your documents together, right? Really managing and organizing with the right support, then you're ready when you get to that point of trying to prove to a lender or trying to go after more funding to engage in the process. Similarly to when you're going after to buy a house, you don't want to wait until that moment in order to secure. And so keeping a mindset that's growth-based and focused and rooted in, I will reach the goal, is another really key piece of going after funding. I know we're short on time. Let me go to the next slide. And so some of the key things, I know we're going to open up to discussion with us, but I'll almost swip. Do you want me to switch and give final pieces of advice, Janine, or do you want us to just open up for questions? I know there's not a lot of time.
Let's go ahead and open up for questions since
Awesome.
we do have quite a few. Okay, Ashley, I think there's a good one for you.
Okay.
What strings are attached to funding?
What strings are attached to funding? This is a loaded question, because you would like to believe there's no strings attached, but there's no such thing. So anyone telling you that is not telling you the truth. Beyond what is inherent to just like any type of funding or financing, there's going to be some type of percentage of interest to gain. There's going to be stakeholder, stock options. So those are kind of the things that you readily think of. But sometimes there are also conditions of coaching or partaking in programming and support from some of our founders that are beneficial. We are a portfolio company for Founders First, but one of the conditions is to also make sure that we can take some coaching support, and that has been viable, supportive, and helpful. And so it's not to think that all strings mean negative strings, right? But there are strings like that you'll see. I'm dealing with one investor now where there is the condition of having an observation seat on the board. And so that's something I hadn't seen before, that we haven't seen with other investors. And so that's a new one. Requirements of getting, up to date, not only the financials, but maybe a newsletter or having a quarterly check-in. Those are some of the most common strings I've seen.
Thank you.
Mm-hmm.
Danica, this one is a good one for you. I have a tax accountant. Do I also need a bookkeeper?
Okay, yeah, this is a very good question. We find a lot of times that people are using their tax accountant for bookkeeping. And again, this could be due to cash constraints and things of that nature. And in that situation, I do understand. I would encourage the person to also get a financial accountant to do a final review at least once a year. Bookkeeping for taxes is a little bit different than bookkeeping for management reporting, bookkeeping for GAAP accounting and things of that nature. So you should have a separate person if it's affordable to you. If you cannot afford it, I would at least advise that once a year you have somebody that's, a CPA on the financial side that understands GAAP accounting to review it. Now, that is not to say that not all tax accountants, they also know this. I'm just saying in general, most tax accountants are doing bookkeeping specific for taxes, meaning they want to keep your records for tax books, but not necessarily for management reporting and financial books. And Jules, I don't know if you want to add anything to that, because I know this is something you work with quite a bit. So you're welcome to add anything you want.
Oh, thank you. This is just one of those instances where I would say it is cheaper in the long run to engage a bookkeeper / accountant in the beginning. It's much more expensive to go back and fix multiple years later. Where Danica referred to the shoebox earlier, what we definitely recommend is don't keep your records in a pile. I used to have one client, I used to have to remind him that files are not piles. So I had one client many years ago who brought me all of her records with her business and personal all mixed together in a Neiman Marcus shopping bag. So what I would tell you is, even if it's the most simple system, if it makes sense to you, do it. Use some type of organization. Make sure you keep receipts for all the things for your business to be able to prove that you're spending that money, because you'll need that in the end, both for bookkeeping purposes and tax purposes.
Okay, let's keep going here. If you need to hop off, the recording will be provided, but we do have a couple more questions we'd like to get to. Really quickly, and anyone who wants to answer this one, if you've not kept these statements before, where should you begin?
I'll take that one. The answer is the easiest time to start is now rather than later. If you don't have them for previous years, if you have the records, the receipts of what you've spent, it's still able, very, I'm not gonna say it's easy, but it's still able to produce financial statements for past years now. So the answer is, find, an accountant, bookkeeper, CPA, talk to them about your situation and, get some help, get somebody who can teach you the best way to do it going forward, but get some help on how you can produce financials from prior years if that's what you're needing.
Great, thank you for that, Jules. Here's a question maybe for Ashley. What funding is available for startup companies?
I'm glad you asked, Janine. I was trying to type in the chat there. I saw that there was a question from someone directly kind of in the similar vein. And so if you're pre-revenue or you're a startup, there are, it's the same type of funding that you would go after, if you weren't. The difference is, you're looking at the Series A or seed funding, startup funds. So, you may not have financial statements beyond your own personal account and things of that nature. What I would say is you can start with a Google search of, who is investing in startups right now? Where can I find seed money? Those are some good keyword searches to start with. I included in the chat, hopefully everyone can see, and it didn't go directly to an individual, but there is various resources there's one called PitchBook that just gives you access to a venture capital database where you can literally put in filters around what stage of the game you're in, and then it can tell you, if there are angel investors, if there are foundations or other people who are investing in that series.
Thank you, Ashley.
Mm-hmm.
I've got another question here, I think for Danica. What is good software to create financial statements?
That's a good question. Like Jules said, there are so many softwares out there. So anything that you are comfortable with, we can recommend a few. But again, most people will say QuickBooks Online or QuickBooks Desktop. Most people will, gear towards QuickBooks Online because there's a little bit more ease of use with multiple parties. But again, it's mainly because that's what's available. So if it depends on your budget, it depends on how much, if you have an accountant doing it, if you're doing it yourself. If you're doing it yourself, QuickBooks Online is probably the best option. Again, there are some other options out there as well. If you can't afford QuickBooks Online, if you're, a startup and you're really tight, you can also use a spreadsheet as long as you're managing it and kind of creating financials from that spreadsheet. But if you can, a software would really help you kind of ensure that you have accurate financial statements on a regular basis.
Okay, let's ask this one last question. How many years worth of statements do funders typically require?
Like Ashley was kind of mentioning earlier, it's typically 3 years. However, I have seen that, sometimes they're a little bit more lean and they say, hey, we'll take 2 years if you have a really strong business model. I would say the average is 3 years. And sometimes let's say that you might not have the best business model at this time. They might want to see 5 years. So it really depends, but I would say the average is 3 years.
Okay, thank you, Danica. Well, I know we're a little bit over time, so we'll go ahead and hop off. I'd like to thank our speakers today, Danica, Jules, and Ashley, for sharing their wisdom and insights. I'd also like to encourage everyone, if you have not visited our website, we are at foundersfirstcdc.org, and you can sign up for our newsletter to make sure that you catch our monthly webinars. Thank you, everyone. Have a great day.
Thank you. Have an awesome day.